Hello, baby. Hello.
Hello, Z, how are you?
I'm good. Long time.
Long time, sir. What do you
Pane zvazvakandivharira but zvakazopera manje.
tinotenda.
Now, today what we want to look at, I want to look at corporate tax or income tax, right? So
Yes.
in your previous studies, you did this, but you did income tax for individuals, which we call pay as you earn when it comes to accounting for a company. Then there is income tax for corporates. That's what we want to look at, right? So this income tax is mostly based on the financial reports, especially the income statement that you present to ZIMRA, right? So you do your accounting from January to December. Yeah. Then after that, you have to present a return to ZIMRA. But in between, you also have to present what they call quarterly payment days. So they're saying instead of you like making one large payment at the end of the year, quarterly you have to be paying a portion of that tax. So how do you do that now? So you have to come up with a projection because by, let's say for March, like March right now, by 20 March, companies have submitted QPDs or quarterly payment days payments, right? Uh, So either you can just wait up to until probably 20 or around 15 March, then you make an estimate. But what Zimra expects you to do is to make an estimate of your incomes, of your expenses, and everything. Then based on that, you calculate your tax, right? Then if from there onwards, you pay the quarterly payment days. We're going to go to the portal so that you see how this is done. But more importantly, we have to understand because we are coming from your income statement that you do on it could be on Sage Evolution, it could be on Sage Bastille Partner, or whatever accounting system that you are using. So you are coming from that income statement, then going to the ZIMRA portal or to the tax accounting method so that you compute the tax to be paid. Right. So we are saying we've got our income statement. Then on the portal now, let me just probably go and share the portal so that you appreciate this. All right. I just want to share the portal. Okay. Where is it? Okay, portal. I've got many windows opened. I want a browser. Where is my browser? SSP Google Chrome. All right. Okay, no, that's fine. I think I've shared it. So now on the portal, so you are not like paying your taxes based on like sort of actuals, but based on estimates. So I want to go back to the portal. I hope you are seeing my portal, right? So just allow it to load up. So on your portal, where you are coming to tax return management. Then you are looking at pending tax returns. That's what you're looking at. When you are doing your monthly returns or whatever, a periodic return, you find it in your terms under tax return management. Then you just look for pending tax returns. That will show you the returns that are outstanding. So ZIMRA loads up the returns that are outstanding. Then you work on those returns. So like, as you can see for this company, the tax return for the first quarter, this is income statement. This is income or corporate tax. The tax that we are dealing with here is income, or what I could say, what I could call corporate tax. So this company has got an income tax provision return outstanding for the first quarter. an income tax provision return outstanding for the fourth quarter. This is for 2025. So the quarterly payments there are four, right? There are four. One in March, one in June, one in September, then one in December to complete them. So if you are managing for a business, you have to be taking note of this. And as I said, these returns are purely based on your income statement. They are based on this. They are based on this. So, right, we're going to come here and see. So you do your quarterly payment or quarterly provisional payments or returns. Then at the end of the year, by the 13th of April of the next year, like in this case, you can see the submission date today. You should have done what we term an income tax self-assessment return for business. Now, this one is now based on this income tax provisional return. So you have done, okay, let's say for 2025, you did your QPDs, we just call them QPDs for shortcut. You did your QPDs, you made a return March, June, September, December, right? So you made 4. At the end of that, you have to do what we term an income tax self-assessment return, which is based on the QPDs that you did, right? So the difference in terms of figures of this income tax self-assessment return for business that you do by 30th of April of the next year, the difference has to be, I think ZIMRA allows about 10%, 10 or less. So it doesn't have to be like a very big margin, because when it is now a big margin, they will penalize you for that. So your estimates have to be sort of accurate, right? I'm going to come back to this income tax provisional return. But first, I want to focus on this income statement because you need to know how to compute your tax. Because the issue is on first being able to compute your tax. Because when you come here, when you come to these returns, you are simply inputting figures. You are no longer calculating. You should have done your calculations here on the income tax. All right. And the rules we see Hello.
Hello.
Yes. Is it understandable what I'm explaining?
Yes, it's very clear.
All right. Now, so when we do our accounting, what we term that financial accounting. When you are doing your accounting, whether you're using Sage or you're using any whatever accounting software, what we are doing there is what we call financial accounting. So you are doing to present those reports either to management, to present those reports either to banks or any other stakeholder, right? So you do what we term financial accounting. So your financial accounting has revenues. It could be sales. You may have any name there. It could be income, sales, revenue. Right? Then you've got cost of sales. Then you've got gross profit. Right? With the ZIMRA, we agree on this. We agree on that. Yes, sales, cost of sales, gross profit. We agree. Then we come to expenses. Now, on expenses, we agree on most of the expenses. Right. You need to take note of that. But when you come to depreciation, you see this depreciation. ZIMRA doesn't acknowledge the depreciation that you compute in your tax accounting. ZIMRA doesn't acknowledge that depreciation. Now, ZIMRA has got its own depreciation, which it calls capital allowances. Let me just put something so that I explain this. What is key? The return is not difficult. What is key is your ability to make sure that the computations that you are submitting are accurate. So I need to explain some concepts. You did this in school, I know very well, but probably I just want to refresh your mind so that you appreciate what this is all about. Some of the concepts I'm going to explain them when we are doing the return, because we're going to try to do one return and see how it goes. Right. So I want to share. Let me just share this screen. Let me just share this screen so that we move on and talk about. So I want to share this one. Right. Let me share. So on depreciation, in financial accounting, we have got depreciation. So we've got our depreciation, and I could just say depreciation and amortization, right? So you've got your depreciation there, and amortization, right? So on depreciation, you would find, depending with the asset category, you've got different rates. So you've got different rates for depreciation, right? If it is for motor vehicles, some companies, they depreciate at 20% per annum, which means they write off the car in 5 years. For buildings, it could be less. For furniture and fittings, it could be 25%. Like for computer equipment, it could be 25%. So depending on the asset category, a company may depreciate an asset using different rates. So we are saying, okay, that's fine. Now, when it comes to Zimra, Zimra has got two categories of depreciation. Okay, two names for that. So they've got umbrella. The umbrella name is capital allowance. So when you come to tax now, they are no longer talking about depreciation. Depreciation is now replaced with capital allowances. I think you're aware of that. Now, under the capital allowances, you've got what we term as special initial allowance. So you've got this as a way. So this one, you are supposed to claim in the first year of the asset. In the first year, okay. So let's say you buy an asset this year, 2026. So in the first year of the asset, you can claim 25%. The next year, so you can claim 50%. The next year, you claim 25%. Then the third year, you claim 25%. By so doing, the asset is written off. In other words, you have claimed all the depreciation that is due on that asset, right? Okay. I spoke about special initial allowance. This is number one. So initial allowance. Then you also have got what they call wear and tear. Wear and tear. Now, this one has got lesser rates. Depending again with the asset, you can claim 2%, you can claim 5%. But this one now, because the rates are low, what it means is the years on which you are going to claim, there are going to be many. Because, okay, let's say probably you're claiming 2% on the asset. It means it's going to take you a bit of time, probably 10 years or even more, right? 5%. So the difference between the capital allowances, which Zimra allows, and the depreciation that companies use, both in financial accounting, you have got depreciation rates that are sort of standard, especially with the accounting financial reporting standards. Okay, this is good for financial accounting. But for Zimra or for tax accounting, the depreciation has to be replaced with capital allowances. Now, these capital allowances, you have to select. You have to, like, when you buy an asset, let's say you buy a motor vehicle, a delivered motor vehicle, you have to elect or select which one do you want to use. Do you want to use special initial allowance? If you select, it means you're going to use these rates. These are given by Zimra. You don't select them. If you select wear and tear, then you have to find and see which rate is applicable to motor vehicles. So once you select that or elect to use a particular method, you stick to that until that asset is written off. So what does that mean? It means if you've got a list of assets, right, on which you claimed depreciation, list of assets, and then you calculated depreciation on that, right? Depreciation. It means for tax accounting now, you have to recalculate, right? For tax accounting, now you have to recalculate so that you replace your depreciation, this depreciation figure. Let's probably let me just go to our income statement. I just want to share that income statement so that so we are saying, instead of you, like in this case, okay, never mind the years there. Let's just assume 2019 is our current year. Let's say we had, for financial accounting, we had used these depreciation figures. For tax accounting, it means instead of us having depreciation and amortization, we're going to have capital allowances. Then the figure that we calculated based on the method that we elected to use, either special initial allowance or wear and tear, depending on the figure which came up, that is the figure which is going to come up on the tax accounting. I would call it a tax accounting financial or income statement. Is the figure which is going to come up there. Right. So normally what we do, okay, this report you have prepared it, you have presented it to management, and normally we say, okay, can you change this? No, normally we say you don't have to change this. You do not have to do another income statement, a full income statement like for Zimra. You do not necessarily have to do that. What you can do after this report, like just after you come and you do this. So we've got net profit, like in our case, we've got net profit, we want net profit before tax. So we've got net profit before tax of that much, of 39,000. The net profit before tax of which I'm talking about is that. So we've got net profit of that much of 39,825. So this is net profit before tax. So instead of you redoing a complete income statement for tax purposes, you do what you just term is sort of an adjustment statement whereby you show the tax computations. Now, how do you do that? Let me just share this window and demonstrate. So we are saying in your reports, you could just come down here. So we could say net profit before tax. Right. So in our case, we have 39,825.00. Then you have to say add depreciation. This depreciation that you are adding is the depreciation which is in your financial income statement, right? In amortization. So you are adding back that. The figure was about 13,000. I'm correct. Okay, I'm just going to put 13,800. So you are adding back that. Right. So this is one item. Okay, I'm going to come back to this statement. I want to go back again to your income statement and explain another expense that we have to take care of, right? So, okay, wages and salaries and the rest of the expenses are okay. But we may have expenses like fines, right? So if you have expenses like your fines, they are disallowed. The fines we are talking of is probably you got a fine, a driving fine. You got a fine. It could be from. It could be like even the Zimra penalties. Probably they gave you a penalty. You may have got a fine from your city council. So in terms of financial accounting, those are expenses. We include them. We include them in our income statement. But when we come to the computation of the tax, the computation of the tax payable, those fines have to be added back. So things like fines, you have to add them back. So you add back fines. In our statement, we don't have fines, but I'm just putting up this so that you understand. So let's probably we paid 900 for fines. So you add back that. The other thing that you have to add back is expenses for lawyers. If you paid fees for lawyers, probably you hired a lawyer to attend to certain issues, you have to add that back. Now, when you add those things back, you could find, okay, let me probably just add the two. You're going to have a new total there. You're going to have a new total instead of 39,000 that we had before tax. It means we are going, let me just quickly add that and see how much I'm going to have. Just see how much I'm going to have there. So I have 39,825, then plus 13,800, then plus 900. So my new figure here becomes okay. So I could just put total. I could just put total there. There is no harm. So I will just put total there. Then my new total, which I have, is 54,525.07. right? Then the thing that I have to subtract now is less capital allowances. Less capital allowances. Right. So my capital allowances, depending on what I got up here, right, I should have got a figure which is probably higher than this 13,000 or less. That is the figure which I'm going to put there. Okay, so let's say probably after doing my computations, I found I got 8,500 for capital allowances. Then it means I'm going to say now 54,525 minus 8,500, which means my taxable income or my net profit before tax, and my recalculated, I could just say recalculated, you can give it whatever name, net profit before tax becomes, in this case, I'm saying 54. So I'm saying 54 subtract 8,500, and that will give me 46,005.00. So based on this now, I calculate my tax payable. So your tax payable is, you have got your income tax, which is 25%. So you have got income tax at 25%, right? Let me just put up that 25%. So the 25%, we are putting 25% on the 46. So we would say times 25%. So I'm getting about, I'm just getting about 11,000. Let me see what I have here. 11,506.25. Then I have to add as levy. Now the as levy is at 3%. 3% of the 11,000. You understand? 3% of the income tax which I calculated, which is of the 11,506. That's my as levy. So in this case, my as levy becomes what? Becomes 345 point. I'm just going to round off 0.90, which means my income tax, the total income tax payable now, income tax payable becomes, so it will be 11,000 plus 345, the as levy. So those are the figures I'm going to add, 11,506.25. So my payable becomes 11,851. I'm just going to round off this 0.44. So this is my payable income. Now I'm saying this computation, you are doing it before you go to do your return. Okay, I think we'll be cut off anytime from now. It's still okay. We'll just reconnect and continue. I want you to grasp this so that you are able to do it. So I'm saying this computation, like in this case, we may have made an estimate, like, okay, let's assume that probably we made an estimate for the whole year based on this, right? Based on this, right? Then we have done a computation for what we actually have to pay based on what? Based on that. Which means in this case, we are saying for the year, we assume we are going to be paying this kind of income, income tax. This is for the whole year. Now, quarterly, you now have to apply a percentage. So these percentages are staggered. 10%. Okay, let me probably load up that so that you actually see the percentages so that we do it in full. QPDs. So what I want, if I'm saying anything that is not clear, please stop me. We're going to go to the portal. As I said, the portal is not complicated. The portal is, to me, it's not very complicated. So I'm just going to share. Let me share this screen. Let me share this screen. I want to share this screen. Okay. Let me share this. So I want to go back and share this. So our QPDs, based on the tax that we calculated, we said, okay, based on our estimate, we are looking at paying 11,851. Now, quarterly, if our estimate is accurate, it means quarterly we're going to say 10% of the 11,850 by the 25th of March, 25% of that by the 25th of June, 30% of that by the 25th of September, 35% of that by the 20th of December. So this is how you actually pay. This is how you do your payments. Now, if by this date you realize that there has been a significant change, you may realize that there's been a significant change in the estimates that you did. Probably you had done your estimates, but you realize that there's been a change in these figures, which is a bit significant. It's not supposed to be very significant. It means your computation, this computation is also going to change. This computation that we did here, it will also change. The same happens when you go to June and you realize that, okay, fine, we had done estimates, but from the look of it, either we're going to have more sales or we're going to have more less sales or whatever. Then you have to recalculate so that whatever you're paying by that period tallies or is close to what you have calculated. So this job has to be done before you start doing your returns. Because when you go to do the returns, you are doing the returns based on these computations. You are taking the computations, then you're going to the portal, right? Before I go to the portal, I would want to know if you have understood the concept, what I have explained, this concept first, before we go on and see how we do it on the portal. Hello, yes, are you there? Whoa. Hello? All right, hello. Hello, are you there? Hello? I can't hear you.
Sorry for the
All right. What? Okay.
interruption.
All right. I was just asking if what I was explaining, if it is clear to you, is it something that you can follow? Is it something that you can do?
Ingopinda makosi.
Sorry? I think you've got a network problem. Okay, what is it?